Welcome back to Capitura, where we decode the wisdom of the financial elite to build the mental frameworks necessary for wealth and sovereignty in the modern age. Today, we are not just reading a book. We are actively installing a firewall for your mind. We live in an era that is theoretically the most informed in human history. You have some human knowledge in your pocket, real-time market data at your fingertips, and artificial intelligence capable of processing billions of operations per second. And yet, look around you. Are we actually better at predicting what comes next? Or are we simply more confident in our ignorance? We are drowning in information, yet we are starving for wisdom. We are besieged by a relentless storm of data points, tweets, ticker symbols, and breaking news alerts. This is the noise. And somewhere, buried beneath that avalanche of distraction, is the truth, the signal. The book we are dissecting today is The Signal and the Noise by Nate Silver. Silver is not just a statistician. He is a modern oracle who revolutionized how we view baseball, politics, and uncertainty itself. But this book is not merely about history or sports. It is a manifesto on why predictions fail and how we can stop lying to ourselves about the future. In a world of zero DT options, AI-generated hallucinations, and algorithmic market manipulation, Nate Silver's methodology is the compass you need to navigate the chaos of the 2020s. To understand the gravity of Silver's thesis, we must first look at the catastrophic failure prediction that serves as its opening case study, the 2008 financial crisis. Silver dissects how the rating agencies, Standard & Poor's, Moody's, and Fitch, failed spectacularly. They took mortgage-backed securities, which were essentially toxic waste, and stamped them with AAA ratings, labeling them as safe as government bonds. The failure wasn't just corruption. It was a failure of their models. They assumed that housing prices across the United States were uncorrelated, that a crash in Florida wouldn't necessarily happen at the same time as a crash in California. They were relying on historical data from a period of stability to predict a period of chaos. They mistook the noise of a temporary housing boom for the signal of permanent prosperity. So, why does this matter today, nearly 2 decades later? Because we are seeing the exact same arrogance in the age of artificial intelligence and decentralized finance. When you look at the collapse of major crypto exchanges or the implosion of algorithmic stablecoins, you are seeing the ghost of 2008. These modern platforms often rely on backtesting, running their trading strategies against past market data to prove they are profitable. But just like the rating agencies, they are often fitting their models to a specific bullish time frame. A trading bot that made you 300% returns during the post-pandemic stimulus liquidity injection is likely to wipe you out during a quantitative tightening cycle. The modern investor looks at a yield farm offering 20% APY and assumes it is a signal of innovation, when in reality, it is often just the noise of a Ponzi structure waiting for a volatility trigger. Silver warns us that models based on limited data are not predictions. They are merely descriptions of the past masquerading as maps of the future. This brings us to one of the most vital psychological distinctions Silver makes, borrowed from the philosopher Isaiah Berlin: the difference between the hedgehog and the fox. The hedgehog is a thinker who knows one big thing. They have a grand theory of the world, whether it's socialism is evil, Bitcoin goes to infinity, or tech stocks only go up. They view every single event through the solitary lens. They are loud, they are confident, and they are incredibly telegenic. The fox, on the other hand, knows many little things. They are multidisciplinary, adaptable, and willing to acknowledge uncertainty. Silver's research shows that in the realm of political and economic forecasting, foxes consistently outperform hedgehogs. The hedgehogs are great for television ratings because they scream with certainty, but they are terrible for your portfolio. In the context of the 2024 and 2025 landscape, the hedgehog is a Twitter or X guru with laser eyes, or the perma-bear economist predicting a depression every single month for the last 10 years. The hedgehog tells you that AI will inevitably solve everything, or that the dollar will inevitably collapse tomorrow. They sell you certainty in an uncertain world. But to survive in the markets today, you must become a fox. You must look at the bond yield curves, but also look at geopolitical tensions in the supply chain, while considering the regulatory headwinds of the SEC and the adoption curves of new technology. A fox doesn't say, Buy this stock because it's the future. A fox says, this asset has a 60% probability of upside based on current liquidity, but if inflation prints hot next week, I need to hedge my downside. The modern takeaway is that if you are following an influencer who never changes their mind, you are following a hedgehog off a cliff. Agility, not ideology, is the currency of the future. We must then turn our attention to the mechanics of prediction itself, specifically the concept of Bayesian probability. This is the beating heart of Silver's philosophy. Named after the Reverend Thomas Bayes, this theorem is essentially a mathematical formula for changing your mind. In the traditional, static way of thinking, we hold a belief and defend it against new information. In Bayesian thinking, we hold a prior probability, our initial estimate of how likely something is, and then we update that probability as new evidence emerges. It is a continuous loop of learning. You never reach 100% certainty. You only inch closer to the truth. This concept is the absolute killer app for the modern trader and investor. Consider the rise of a new technology stock or a speculative asset class. The hedgehog buys in because of hype and holds on until it goes to zero, screaming about diamond hands. The Bayesian investor, however, starts with a prior belief, perhaps a 20% chance this company succeeds. When the company releases a beta product that works, the Bayesian updates that probability to 40%. When the CEO sells a massive chunk of shares, the Bayesian downgrades the probability to 30%. They are not emotional, they are fluid. In an age where information travels at the speed of light, being static is a death sentence. If you held on to your prior belief that interest rates would stay near zero forever, you were decimated in 2022 and 2023. The signal was the Federal Reserve's announcements. The noise was a market rallying on false hope. You must treat your convictions not as identities to be defended, but as hypotheses to be tested. Silver also takes us into the chaotic world of weather forecasting to illustrate the limits of our power. He explains that weather forecasts have improved dramatically over the last few decades because meteorologists understand the physics of the atmosphere. However, they also know that the further out you look, the more chaos takes over. A forecast for tomorrow is highly accurate. A forecast for 2 weeks from now is little better than a guess. This is due to the butterfly effect, where small discrepancies in the initial data expand exponentially over time. The pivot to our current financial reality here is crucial. We often treat economic forecasts like physics, assuming we can predict the stock market or GDP for the next year with precision. But the economy is not a physical system governed by immutable laws. It is a complex, adaptive system driven by human psychology and reaction. In the age of high-frequency trading, HFT, and AI-driven market making, the chaos is amplified. We see flash crashes where billions of dollars evaporate in seconds because algorithms reacted to other algorithms in a feedback loop. The modern investor must understand that long-term predictions about price targets, like Bitcoin to $1 million by 2030, are functionally useless noise. They're weather forecasts for a decade from now. What matters is understanding the current climate. Are we in a high-volatility regime? Are we in a liquidity crisis? Focus on immediate conditions and risk management, rather than betting the farm on a distant, chaotic future. Furthermore, Silver delves into the world of poker to explain the role of the human element in a mathematical game. In poker, you aren't just playing the cards. You are playing the player. You are looking for tells. Even if the math says you should fold, if you know your opponent is scared, you might raise. This distinction is vital because we often assume that because markets are digital, they are purely logical. They are not. In the digital age, the poker game has moved to the charts and the order books. The rise of meme stocks like GameStop or AMC was a massive collective bluff against the institutional hedge funds. The fundamental value of the companies, the cards, mattered less than the psychological warfare, the betting. The retail traders realized that if they all bought at once, they could force a short squeeze, panicking the hedge funds into buying back shares, which drove the price higher. This was a signal, but not a fundamental one. It was a behavioral signal. Similarly, in the crypto markets, much of the movement is driven by sentiment, by fear of missing out, FOMO, and by panic selling. If you are analyzing a meme coin using traditional P/E ratios, you are bringing a calculator to a knife fight. You need to understand the psychology of the crowd. The signal in these markets is often found in social sentiment analysis, tracking the volume of discussions on Reddit or Discord, rather than in the balance sheets. However, Silver warns us sternly about the danger of overfitting. This occurs when we mistake random noise for a predictive pattern. He uses the example of earthquake prediction. For years, scientists tried to find patterns, suggesting that earthquakes happen more often during certain moon phases or tides. They found correlations in the past data, but those correlations vanished when tested against the future. They had overfitted the data. They found a pattern that was just a coincidence. This is perhaps the most dangerous trap for the modern-day trader using technical analysis. You open your charting software and you have hundreds of indicators: RSI, MACD, Bollinger Bands, Fibonacci retracements. If you look hard enough at a chart of a random number generator, you'll eventually find a head and shoulders pattern or a golden cross. The human brain is a pattern recognition machine. We are wired to see faces in the clouds and signals in the noise. In the world of crypto and penny stocks, millions of dollars are lost every day because traders see a pattern that is purely random. They mistake the noise of low-volume trading for the signal of a breakout. Furthermore, with the advent of generative AI, we are now able to produce limitless amounts of convincing-sounding text and realistic-looking images. We face the risk of overfitting our understanding of the world based on synthetic data. We must be rigorously skeptical. Just because a line on a chart looks like it's following a pattern does not mean it has predictive power, unless there is a fundamental reason driving it. Silver also touches upon the concept of the winner's curse in auctions and competitive bidding, which have profound implications for the modern housing market and tech valuations. The winner's curse states that in an auction with many bidders, the winner is usually the one who most overestimated the value of the item. If you win a bidding war for a house in a hot market, or if a venture capital firm wins a deal to invest in the hottest new AI startup, it often means they paid more than anyone else thought it was worth. In the current landscape of AI hype, where valuations for startups are hitting billions of dollars with zero revenue, we are seeing the winner's curse in real time. Investors are so terrified of missing the next Google that they are bidding up the price of noise, companies that are little more than a wrapper around OpenAI's API. The signal here is to be contrarian. When everyone is rushing to bid, the value is likely gone. The time to buy is when the auction room is empty. Finally, we reach the philosophical conclusion of Silver's work, which is the acceptance of uncertainty. We crave certainty because it makes us feel safe. We want a YouTube guru to tell us exactly which coin to buy. We want the politician to tell us exactly how they will fix the economy. But Silver argues that this craving for certainty is what makes us vulnerable to charlatans and catastrophic errors. The only honest way to view the future is in terms of probabilities. As we conclude this deep dive into the signal and the noise, the ultimate takeaway for the Capitura community is that you must become the editor of your own information diet. The internet is a fire hose of noise designed to capture your attention and sell it to advertisers. The breaking news banner is rarely a signal. It is usually a distraction. The frantic movements of the 1-minute chart are rarely a signal. They are market noise. The signal is found in the long-term trends, the fundamental data, and the quiet, updated probabilities of the Bayesian mind. You need to build a mental shield. When you see a headline, ask yourself, is this predictive or is it descriptive? When you see a market movement, ask, is this a structural shift or is it variance? Stop trying to be a hedgehog who knows what will happen. Start being a fox who knows what might happen and is prepared for multiple outcomes. In a world increasingly run by black box algorithms and artificial intelligence, the ultimate edge is a human mind that can discern the truth from the static. To continue our deep dive into the architecture of prediction, we must pivot from the macroeconomics of the financial crisis and philosophy of probability to the granular, data-rich battlegrounds where Nate Silver first made his name, the world of baseball and the rise of sabermetrics. While you might not care about batting averages or on-base percentages, you absolutely must care about the revolution that started in sports because it has now consumed the entire global economy. Silver describes a tension between the old-school baseball scouts, men who relied on gut instinct, the look of a player's jawline, and the sound of ball hitting the bat, and the new breed of data analysts who looked exclusively at the spreadsheets. For decades, the scouts controlled the narrative. They were the hedgehogs of the sport, convinced that their decades of experience gave them a mystical ability to predict talent. But as the book Moneyball and Silver's own Pagoda system prove, the scouts were often wrong. They were biased by what they could see, the flashy athletic play, and missed the boring, invisible statistics that actually won games, like the ability to draw a walk. This transition from gut feel to data dominance is the exact story of the modern workplace and the digital marketplace of 2025. Today, we are all playing Moneyball, whether we realize it or not. In the corporate world, this is a shift from hiring based on a firm handshake to hiring based on AI-screened resumes and psychometric data points. In the financial markets, it is the death of the floor traders shouting orders and the rise of quantitative analysts writing Python scripts. But Silver introduces a critical nuance that is often lost in the worship of algorithms. The data does not capture everything. When Silver developed his forecasting system, he didn't just look at the numbers. He acknowledged that players were human beings who aged, got injured, and suffered from psychological pressure. The noise was thinking that a player's performance last year would perfectly replicate this year, without accounting for the aging curve. The signal was finding the hidden metrics that indicated longevity. For the modern operator in the crypto or stock markets, this lesson is profound. We are currently seeing a dangerous over-reliance on on-chain data and technical indicators. Traders will look at a chart and say, the RSI is oversold, therefore it must bounce. They are acting like the bad version of the data analyst, looking at the spreadsheet but ignoring the context. The scout mentality, the human element, is still necessary. Why? Because markets are moved by narratives, not just math. A crypto token might have terrible fundamentals, bad stats, but if it has a cult-like community, the intangibles, it will outperform the better asset. The modern master of prediction must be a hybrid. You need the quantitative rigor of the data analyst to manage risk, but you need the intuition of the scout to understand the meme, the narrative, and human emotion driving the price. If you rely solely on the data in a hypersocial viral economy, you'll get run over by a movement you didn't see on the spreadsheet. We must then navigate to one of the most prescient chapters in Silver's work regarding the failure of big data, specifically the case of Google flu trends. In the late 2000s, Google thought they had solved epidemiology by tracking search terms like flu symptoms or pharmacy near me. They claimed they could predict flu outbreaks faster and more accurately than the Centers for Disease Control, CDC. For a while, it worked. It was hailed as the triumph of big data. Who needs doctors when you have search queries? But then it failed catastrophically. It began overestimating flu cases by massive margins. Why? Because the algorithm didn't understand why people were searching. A news report about a flu scare would cause healthy people to search for flu symptoms out of paranoia, and the algorithm, lacking context, interpreted this curiosity as actual sickness. It mistook the noise of public anxiety for the signal of a biological virus. This failure of Google flu trends is the patient zero for understanding the hallucinations of modern artificial intelligence in 2024 and 2025. We are currently interacting with large language models, LLMs, that are essentially hyper-advanced versions of that flu prediction engine. They are predicting the next word in a sentence based on massive amounts of training data. Most of the time, they are miraculous. But like Google flu trends, they lack a fundamental model of the world. They do not know truth. They only know correlation. When you ask an AI for financial advice or legal precedent, it might hallucinate a convincing lie because that lie statistically resembles the truth it has seen in its training data. The modern takeaway here is to treat AI not as an oracle, but as a tireless, incredibly well-read, but occasionally delusional in turn. You must always be the human in the loop to verify the output. If you blindly trust the black box of an AI algorithm to manage your trading bot or write your legal contracts without auditing code, you are making the same mistake Google made. You are confusing the volume of data with the veracity of insight. Deepening this exploration of the black box, Silver turns his attention to the world of chess and the legendary duel between Garry Kasparov and IBM's Deep Blue. When Kasparov lost a computer in 1997, it was seen as a blow to human dignity. It was the moment the machine surpassed the master. But Silver draws a different, more optimistic conclusion from the aftermath. After his defeat, Kasparov didn't reject computers. He invented freestyle chess, where humans pair with computers play against other human-computer teams. The result was fascinating. A grandmaster working with a machine could beat a standalone machine, and, more surprisingly, average players with good processors and machines could beat grandmasters with machines. The signal here is that the human contribution is strategic guidance, creativity, and identify when the computer is stuck in a loop. The computer provides tactical perfection and error checking. This is a centaur model, and it is the single most important career strategy for the rest of this decade. The narrative that AI will take your job is noise. The signal is that a human using AI will take the job of a human who doesn't. In the realm of high finance or content creation, the winners are not those who resist AI, nor those who let AI do everything on autopilot. The winners are the centaurs. For example, a centaur trader uses AI to scan thousands of charts for patterns, the machine's strength, but uses their own judgment to interpret the geopolitical news that might invalidate those patterns, the human strength. A centaur writer uses AI to generate outlines and research summaries, but writes the final prose with emotional resonance and wit. We must stop viewing technology as an opponent to be feared, like Kasparov initially did, and start viewing it as an exoskeleton to be worn. The future belongs to the pilot, not the passenger. Moving from the individual to the collective, Silver dissects the mechanics of the wisdom of crowds and prediction markets. He explains that under the right conditions, the average guess of a large group of people is often more accurate than the guess of a single expert. This is why markets generally work. They aggregate all available information. However, Silver warns that this only works when the crowd is diverse and independent. If the crowd is caught in an information cascade, where everyone is listening to the same few influencers and repeating the same opinion, the crowd becomes a mob and the wisdom becomes madness. This creates bubbles and crashes. In 2025, this concept of the information cascade is the primary driver of volatility. We live in a world of algorithmic radicalization. Social media algorithms are designed to show you content that confirms your existing biases, your priors, which turns a diverse crowd into a series of disconnected, homogeneous bubbles. If you are on crypto Twitter, you are constantly fed information that the dollar is collapsing and Bitcoin is the only savior. If you are on skeptic Twitter, you are fed information that it's all a scam. Both groups are in an information cascade, creating massive distortions in price and reality. The Capitura listener must understand that the consensus is often just a reflection of the loudest echo chamber. To find the signal, you must deliberately step outside your algorithm. You must read the bears when you are bullish. You must study the short sellers when you are long. You must use tools like Polymarket, a decentralized prediction market, which Silver would likely champion today. Prediction markets force participants to put money behind their beliefs, which filters out the cheap talk and noise of social media. When money is on the line, the signal gets clearer. Silver also addresses the terrifying difficulty of predicting black swans, rare, high-impact events like terrorist attacks or massive earthquakes. He notes that we have a psychological blind spot for things that haven't happened recently. If there hasn't been a terror attack in 10 years, we assume the risk is zero. If the market has gone up for 5 years, we assume a crash is impossible. We confuse the absence of evidence with the evidence of absence. In complex systems, the risk is often accumulating silently beneath the surface, like tectonic plates building pressure. This is a Turkey problem, a concept also popularized by Nassim Taleb, whom Silver references. A turkey is fed every day for 1,000 days. Every single day, its statistical model confirms that the farmer loves it and wants it to be happy. The turkey's confidence is at its maximum on day 1,000. But day 1,001 is Thanksgiving. The signal was never that the farmer was benevolent. The signal was that the turkey was being fattened for a purpose. In the modern financial context, we see this with yield farming in DeFi or the carry trade in currencies. Investors collect small, steady returns for months or years, assuming the risk is low because it's been working fine. They are picking up pennies in front of a steamroller. The modern takeaway is that you must be paranoid about tail risk. Just because a strategy has a high win rate, it works 99% of the time, doesn't mean it's good if the 1% failure leads to total ruin, bankruptcy. You must structure your life and portfolio to survive the Thanksgiving that the models don't predict. This means self-custody of assets, diversification across jurisdictions, and holding cash reserves that seem inefficient during the boom times but become oxygen during the bust. Furthermore, silver explores the distinction between risk and uncertainty. Risk is when you know the odds, like at a roulette table. You know there's a 1 in 37 chance of hitting your number. Uncertainty is when you don't even know the odds, or perhaps even the rules of the game. The financial models that failed in 2008 try to treat the housing market like a game of roulette, assigning precise probabilities to events. But the economy is a game of uncertainty. We do not know the probability of a global pandemic, or a nuclear escalation, or a breakthrough in fusion energy. This distinction is vital for the modern entrepreneur and investor. We are obsessed with optimization. We want to optimize our morning routine, our portfolio allocation, and our calorie intake. But you can only optimize for risk. You cannot optimize for uncertainty. If you optimize your supply chain to be just in time to save money, treating it like a risk calculation, you become fragile to a global shipping disruption, an uncertainty event. The solution is not optimization, but resilience. Resilience means having slack in the system. It means having multiple income streams so that if one algorithm changes, you don't starve. It means having skills that are transferable. In a world of high uncertainty, driven by rapid technological change and geopolitical instability, the person who is efficient is fragile. The person who is adaptable is anti-fragile. Let us return to the Bayesian framework for a practical application in the age of a 24-hour news cycle. Silver emphasizes that we must update our priors, but the weight of the update matters. Not all news is created equal. A tweet from an anonymous source should barely move your probability needle. A filing with the SEC should move it significantly. But in the heat of the moment, our brains often conflate the two. We see a scary headline and panic. The Bayesian discipline requires a pause. When a new piece of information hits the wire, say, an inflation report or a tech earnings miss, do not react immediately. Ask, how much should this actually change my long-term thesis? For example, imagine you are invested in a major tech company because you believe they will dominate the next decade of AI. Then, they release a disappointing quarterly earnings report, missing revenue targets by 2%. The stock drops 10% in after-hours trading. The noise is the price drop and the panicked headlines. The signal requires investigation. Did they miss revenue because their product is failing, thesis broken dash sell? Or did they miss revenue because they're spending billions buying GPUs to build the future, thesis intact dash by the dip? The hedgehog reacts to the price. The fox reacts to the reason for the price. This deliberate, slow thinking in a fast-moving world is the ultimate competitive advantage. While high-frequency algorithms are scalping pennies based on milliseconds of data, the Bayesian investor is making fortunes by correctly identifying the structural shifts that take months to play out. Finally, we must touch upon the ethical dimension of prediction that Silver alludes to. Predictions are not just neutral observations. They can shape reality. If a prominent analyst predicts a bank run, they can cause a bank run. If a political pollster predicts a landslide, they can suppress voter turnout. We are all forecasters now. When you share a post, when you express a strong opinion online, you are contributing to the signal or the noise of the collective consciousness. In an era of post-truth politics and deep fakes, our responsibility to verify before we amplify is a civic duty of the digital age. We must stop being vectors for noise. As we bring this extended session to a close, remember that The Signal and the Noise is not a book about how to be right all the time. Nate Silver himself admits he is often wrong. It is a book about how to be less wrong over time. It is about the humility to admit what we don't know, the courage to act on probabilities rather than certainties, and a discipline to filter out the cacophony of the modern world to hear the quiet, steady hum of the truth. You have the tools now. You know the difference between the hedgehog and the fox. You understand a Bayesian update. You see the danger of overfitting and the trap of the winner's curse. The next time you open your phone and the avalanche of data tries to bury you, stand firm. You are no longer just a consumer of information. You are a filter. You are the signal. To truly internalize the centaur model we discussed, I want you to identify one repetitive, analytical task you do weekly. Whether it's researching stocks, writing emails, or planning your schedule. This week, do not do it alone, and do not let AI do it all. Actively partner with an AI tool to do it. Feed it your criteria, let it generate options, and then use your scout intuition to select the best one. Report the results to yourself. Did you save time? Did you find a signal you would have missed? This is your first step into the future of work. We continue our relentless excavation of the signal and the noise, moving now into the most treacherous terrain of all, the economy, the climate, and the existential risks that threaten to wipe out not just your portfolio, but the very infrastructure of your life. Nate Silver does not coddle us in these chapters. He exposes the incompetence of so-called experts who steer the global ship, and in doing so, he hands us the keys to navigate the inevitable shipwrecks. We must begin by dismantling the priesthood of modern finance, the economic forecaster. Silver devotes a scathing chapter to the track record of economists predicting GDP growth and recessions. The data is damning. He reveals that economists are notoriously terrible at predicting turning points. They are excellent at predicting that tomorrow will be exactly like today. If the economy grew by 2% last year, they will safely predict 2.1% for next year. But when a recession hits, the actual moment of danger, they almost never see it coming until they are already standing in the rubble. In the months leading up to the 1990, 2001, and 2008 recessions, the consensus forecast was for continued growth. The experts were hurting, terrified of being the outlier who predicted a crash that didn't happen, so they chose to be wrong together rather than right alone. In the landscape of 2025, this herding behavior has metastasized into a systemic risk. We saw this vividly with the transitory inflation narrative of the early 2020s. The Federal Reserve, the Treasury, and the majority of institutional economists looked at the data, the supply chain snarls, the money printing, and concluded it was just noise. They assured us that inflation was a temporary blip. They were wrong. They were mistaking their models, which were built during a 40-year period of deflationary globalization, for reality. The signal was screaming at them. You cannot shut down the global economy, print trillions of dollars, and then restart without consequences. But their models didn't have a variable for a global lockdown followed by liquidity hose, so they ignored it. The modern takeaway for the Capitura investor is to treat consensus not as truth, but as a counterindicator. When the front page of the financial news says soft landing achieved, that is often the moment of maximum danger. When every analyst on TV is screaming recession imminent, that is often the moment the market bottoms and rips higher. Why? Because markets are forward-looking mechanisms. If everyone expects a recession, they have already sold. There is no one left to sell. The signal is found in the positioning, not the prediction. Are the hedge funds loaded up on puts, betting on a crash? If so, a crash is less likely because the market rarely rewards a crowded trade. You must learn to read the sentiment data, the fear and greed index, the put/call ratios, rather than the GDP forecasts. The GDP print is a rear-view mirror. Sentiment is the windshield. This failure of economic forecasting leads us directly into Silver's exploration of feedback loops. In physics, a prediction does not change the outcome. If a meteorologist predicts rain, the clouds don't hear him and decide to stay sunny just to spite him. But in economics and finance, the prediction changes the future. If a famous short seller publishes a report saying a company is a fraud, the stock crashes, the bank cuts off their credit line, and the company goes bankrupt, making the prediction come true. This is reflexivity, a concept championed by George Soros and validated by Silver's analysis. In the digital age, reflexivity is weaponized by algorithms and social media. We see this in the bank runs of the 21st century, like the collapse of Silicon Valley Bank. It wasn't just a balance sheet issue, it was a Twitter run. A few influential VCs tweeted about pulling their money, and within hours, billions of dollars were withdrawn digitally. The prediction of a collapse caused a collapse at the speed of light. For you, the listener, this means you must be hyper-aware of the narrative velocity. In the old world, fundamentals mattered most. In the new world, a false narrative can destroy a fundamentally sound asset before the truth can lace up its boots. You cannot just be a value investor looking at balance sheets. You must be a narrative trader monitoring the feedback loops. If a stable coin loses its peg by 1%, the narrative of collapse can drive it to zero in an hour. The signal is the stability of confidence, not just the stability of collateral. Silver then pivots to a domain where the noise is deafening and the stakes are existential. Climate change. He uses this as a case study for how political ideology corrupts statistical analysis. He contrasts the scientific consensus, which is largely a strong signal that the planet is warming due to human activity, with the media debate, which frames it as a 50-50 toss-up. He points out that while the physics of the greenhouse effect are solid, the signal, the specific models predicting exactly how much the sea level will rise in 50 years are fraught with uncertainty, the noise. The application of this chapter to the 2025 financial landscape is the massive, chaotic, and profitable sector of green tech and ESG, environmental, social, and governance investing. For years, Wall Street packaged ESG as a guaranteed win, a moral and financial free lunch. That was the noise. The reality is that the energy transition is messy, expensive, and nonlinear. Many green stocks were just speculative bubbles with no revenue, riding the narrative. However, the signal remains: the global energy infrastructure is shifting. The smart money, the foxes, are not buying generic ESG ETFs. They are looking at the second-order effects. If the world transitions to EVs and renewables, the signal is a massive structural shortage of copper, lithium, and uranium. The hedgehog says oil is dead. The fox says oil demand will peak, but we haven't invested in new supply for a decade, so oil prices might actually spike during transition. The fox also looks at nuclear energy. For years, the noise of fear kept nuclear down, but a signal of physics, that it is the most density-efficient carbon-free energy, is finally breaking through, driven by the insatiable energy demands of AI data centers. The convergence of AI and energy is the single biggest investment theme of the late 2020s. AI needs massive power. The grid is unstable. The signal points to energy sovereignty, investing in companies that secure their own power or provide microgrid solutions. We must then confront the darkest chapter in Silver's work, the prediction of terror and catastrophic black swans. Silver analyzes a failure to predict Pearl Harbor and 9/11. In both cases, the U.S. government had plenty of data dots, intercepted cables, warnings, suspicious flight training. The problem wasn't a lack of information. It was a lack of a framework to connect the dots. We suffered from a failure of imagination. We couldn't conceive that an enemy would fly planes into buildings, so we treated the warnings as noise. We fit the data to our existing model of hijackings usually end in negotiations, not realizing the game had changed to hijackings as missiles. This is the most chilling and urgent lesson for the modern digital citizen. We are currently suffering from a failure of imagination regarding cyber warfare and digital fragility. We assume the internet is permanent, that the banking app will always open, that the GPS will always work. We are optimizing our lives for a fully connected state. But the signal from geopolitical experts and cybersecurity analysts is flashing red. The next Pearl Harbor will likely not be kinetic. It will be digital. It will be a ransomware attack on the power grid or corruption of the financial ledger. How does the Capitura disciple prepare for this? You do not become a doomsday prepper living in a bunker. That is the hedgehog reaction. You become resilient. You recognize that efficiency is the enemy of security. Having all your assets in one digital brokerage account is efficient, but it is fragile. The fox diversifies not just assets, but custodians. You keep some cash physical. You keep some crypto in a hardware wallet cold storage, independent of any exchange or bank. You maintain physical copies of critical documents. This is not paranoia. It is insurance against the unimaginable. Silver teaches us that the events we fail to predict are usually the ones that have no historical precedent in our lifetime. Just because the grid hasn't gone down in 50 years doesn't mean the probability is zero. It means the risk is accumulating. This discussion of risk brings us back to the poker table, where Silver spent years making a living. He dedicates significant time to the concept of process versus outcome. In poker, you can play a hand perfectly, calculate the odds, make the right bet, and still lose because of a lucky card on the river. This is a bad beat. Conversely, you can play like an idiot, go all in with a terrible hand, and win. The amateur focuses on the outcome. I won, therefore I am a genius. The professional focuses on the process. I made the statistically correct move. The result is just variance. This mental shift is the hardest thing for a trader or entrepreneur to master. In the bull markets of crypto or tech, we saw millions of people confuse luck with genius. They bought a random meme coin. It went up 1,000%, and they thought they had a strategy. They quit their jobs to trade full-time. When the market turned, they were slaughtered because they had no process, only a winning lottery ticket. To survive in 2025, you must ruthlessly audit your wins. Did you make money on that trade because you did the research, identified an asymmetry, and executed a plan? Or did you make money because Jerome Powell turned on the money printer and everything went up? If it was luck, acknowledge it, bank the profit, and don't mistake it for skill. The market eventually punishes bad process, even if it rewards it temporarily. Silver also touches on the psychology of the fish, the bad player. The fish plays for the thrill, for the action. They crave the dopamine of the bet. The pro plays for the ROI. In the era of gamified trading apps, Robinhood, Coinbase, sports betting on your phone, the entire financial system is designed to turn you into a fish. The flashing lights, the confetti animations when you buy, the push notifications. These are all noise designed to trigger your dopamine receptors and make you overtrade. Silver's implied advice here is essentially a dopamine detox for your finances. A boring portfolio is often a profitable one. If you are feeling an adrenaline rush when you place a trade, you are likely gambling, not investing. The signal of a good trade is usually a feeling of calm, calculated attachment, not a racing heart. Let's delve deeper into the efficient market hypothesis, EMH, which Silver critiques with nuance. The EMH states that asset prices reflect all available information, so it's impossible to beat the market consistently. Silver argues that while the market is mostly efficient, it is not perfectly efficient because it is composed of irrational humans. Pockets of inefficiency exist where the noise traders are distorting prices. In 2025, the market structure has changed. We now have passive investing, index funds/ETFs, dominating the landscape. Trillions of dollars flow automatically into the S&P 500 every month, regardless of valuation. This creates a strange distortion. The biggest companies get bigger simply because they're big, not necessarily because they are better. This blind buying creates opportunities for the active fox. When an entire market sells off due to a macro panic, good companies are sold down just as hard as bad ones because the ETFs are selling everything indiscriminately. This is where the signal hunter strikes. You look for the baby thrown out with the bathwater. You look for the small cap companies that are ignored by the mega cap algorithms. The inefficiency today is not in the blue chips, which are analyzed by supercomputers. It is in the forgotten corners of the market, the unloved sectors, the complex assets that require actual reading to understand. That is where the alpha hides. Silver also explores the concept of Bayesian priors in the context of conspiracy theories. Why do some people believe 9/11 was an inside job or that the moon landing was faked? It's because their prior probability of government deception is so high that any evidence, no matter how flimsy, confirms their bias. If you show them proof they are wrong, they interpret the proof as part of the cover-up. This is a profound insight for navigating the post-truth era of the internet. We are surrounded by conspiracy theories, some of which turn out to be true, like government surveillance, but most of which are noise that rots the brain. The Capitura mindset requires a delicate balance. You must be skeptical of official narratives, because institutions lie to protect themselves. But you must not fall into the abyss of nothing is real. You must apply Occam's razor. Does this theory require 10,000 people to keep a secret perfectly for decades? If so, the probability is low. Does it require a few powerful people to act in their own self-interest? If so, the probability is high. Use Bayesian reasoning to filter the alternative news. Don't let your mind become so open that your brain falls out. Finally, we arrive at the ultimate synthesis of Silver's philosophy, the necessity of aggressive humility. The universe is more complex than your brain can comprehend. The economy is a chaotic beast. The future is a fog. The only way to move forward is to admit ignorance. The moment you say, "I know for a fact what will happen," you have stopped learning. The moment you say, "I assign a 70% probability to this outcome, and here's the data that would change my mind," you have started winning. We live in a noisy world. The notifications never stop. The pundits never shut up. The charts never sleep. But you are the calm center. You are the Bayesian processor. You take the noise, you filter it through your models, you update your probabilities, and you act with calculated decisiveness. You do not fear the uncertainty. You exploit it. While the herd is running from the shadow of a cloud, you are calculating the rainfall. While the gamblers are betting on the next card, you are counting the deck. This is the power of the signal and the noise. It is not a crystal ball. It is something better. It is a pair of noise-canceling headphones for your life. It allows you to hear the melody of opportunity amidst a cacophony of chaos. You have the theory. Now you need the practice. I want you to conduct a signal audit on your information diet. Open your YouTube, your Twitter/X, and your news feed. Scroll through the last 20 items. For each one, ask, is this signal timeless, fundamental, data-driven, or is this noise ephemeral, emotional, speculative? Unfollow 3 sources that are pure noise. Replace them with one source that is high-density signal, perhaps a primary source data feed, a historical archive, or yes, this channel. Clean your inputs, and you will clarify your outputs. We press forward into the deepest, most labyrinthine corridors of the signal and the noise, where the stakes rise from mere financial loss to the very fabric of how we govern our societies and perceive reality itself. Nate Silver's work is not merely a critique of bad math. It is a critique of human arrogance. And nowhere is this arrogance more visible, more destructive, and more prevalent than the arena of political prediction and the theater of public opinion. Silver dissects the machinery of political polling with the precision of a surgeon, exposing the rot underneath. In the pre-digital era, polling was relatively straightforward. You called 1,000 landlines, asked people who they were voting for, and because almost everyone had a landline and answered it, you got a representative sample. That world is dead. It has been replaced by a fragmented, paranoid, and digital electorate that is increasingly invisible to traditional radar. The signal of the public has been drowned out by the noise of non-response bias. In 2024 and 2025, pollsters are not calling landlines. They are desperately trying to model an electorate that ghosts them. They are adjusting their models to account for the shy voter, the person who lies to the pollster because they fear social judgment, or the person who refuses to participate in the system entirely. This breakdown of the public square has profound implications for you, the Capitura listener. If you are making business decisions based on the political consensus you see on CNN or Fox News, or even the trending topics on X, formerly Twitter, you are building your castle on quicksand. Silver warns us about herding among pundits when a political narrative takes hold. For example, that a certain candidate is unelectable. Every pundit repeats it to avoid looking foolish. This creates a false consensus. The signal you need to watch is not the punditry, but the incentives. In a polarized economy, the best predictor of political outcomes is often found in the flow of dark money and the betting markets. Prediction markets, which Silver champions, are ruthless because they strip away the virtue signaling. A pundit might say they hate a candidate to get likes, but they might bet on that candidate to win because they like money. In the age of performative politics, money is the only honest voice left. Follow the liquidity, not the lips. Furthermore, we must apply Silver's Fox versus Hedgehog framework to the geopolitical chessboard of the late 2020s. The Hedgehog analyst looks at the U.S.-China relationship and sees only one outcome: inevitable war, the Thucydides trap. They filter every piece of news, a trade tariff, a naval exercise, through this lens of inevitable conflict. The fox, however, sees a complex web of dependencies. The fox acknowledges attention, but also sees the massive economic integration, the internal demographic collapses facing both nations, and the technological races that might render kinetic war obsolete. For the investor, the hedgehog view is dangerous because it leads to all-or-nothing bets. You might sell all your tech stocks fearing a Taiwan invasion that doesn't happen for 10 years, missing out on a decade of compounding. The fox hedges. The fox invests in semiconductor fabrication in Arizona, betting on decoupling, while also holding emerging market indices, betting on coexistence. The fox understands that in geopolitics, the status quo has a powerful inertia, and muddling through is often the most likely outcome, even if it's the least exciting prediction to sell on a podcast. We must then turn our gaze to a phenomenon Silver touches upon that has exploded into a civilization-defining crisis: the distinction between correlation and causation in the age of algorithmic truth. Silver uses a classic example. Ice cream sales and forest fires are highly correlated. They both go up at the same time. Does eating ice cream cause forest fires? No. They are both caused by a third, hidden variable: hot weather. This seems obvious. But in the era of big data and AI, we are drowning in spurious correlations. Our algorithms are churning out billions of connections that look like signals but are just noise. Consider the medical and health advice industry. An AI might analyze millions of health records and find that people who drink a certain obscure tea live longer. This becomes a headline. Super tea extends life. The market for that tea explodes. But the algorithm missed a confounding variable. The only people who can afford that obscure tea are wealthy elites who also have access to the best healthcare and low-stress jobs. The tea didn't save them. Their money did. The signal was wealth. The noise was the tea. In 2025, you are being bombarded with these spurious correlations every day. Successful CEOs wake up at 4 a.m. Do they succeed because they wake up at 4 a.m.? Or do they wake up at 4 a.m. because they are hyper-anxious workaholics who would succeed anyway? Crypto wallets that hold NFTX also hold Token Y. Is there a fundamental link? Or is it just the same group of insiders pumping both? The Capitura mind must be a scalpel that severs a link between correlation and causation. You must always ask, what is the mechanism? If you cannot explain how a cause is B, you are likely looking at a coincidence. Deepening this inquiry, we arrive at the overfitting problem in the context of the culture wars and conspiracy theories. Silver explains that if you have enough data points, you can find a pattern that supports any theory. This is the engine of the modern conspiracy theorist. They look at the noise of history, random symbols in a music video, numbers on a license plate, timestamps of tweets, and they overfit a narrative of a grand global cabal. To the believer, this feels like rigorous research. They are connecting the dots. But Silver shows us that true prediction requires parsimony. The simplest explanation is usually the right one. The more complex the theory, the more variables it requires to go right, and the less likely it is to be true. For you, this matters because conspiracy thinking is a financial liability. We see traders who believe the market is rigged against them specifically. They believe the market makers are hunting their stop losses. While manipulation exists, this mindset is a trap. It externalizes responsibility. If you believe a shadowy cabal controls the price, you stop looking at your own bad entries and poor risk management. You stop learning. You become a victim of the noise rather than a master of the signal. The signal is that markets are competitive, ruthless, and sometimes unfair, but they are not omnipotent. They are composed of millions of agents, often acting in chaos, not coordination. The most profitable conspiracy theory is that the world is actually just incompetent, not malicious. Bet on incompetence, and you will often win. Let us now venture into the realm of Bayesian dating and Bayesian hiring. Silver's principles of probability are not just for charts. They are for people. When you are hiring an employee or choosing a business partner, you are making a prediction about their future performance based on limited past data. Most people function like bad frequentists. They look at the resume, the historical data, and assume it predicts the future perfectly. He worked at Google, so he must be a genius. This is a static assessment. The Bayesian approach is dynamic. You start with a prior. The resume gives you a 60% confidence level. But then you conduct an interview. If they're late, you update down. If they ask insightful questions, you update up. But here's the critical modern application. You must test for adaptability, not just capability. In a world where AI can do the technical work, the signal of a high-value human is their ability to unlearn and relearn. A resume that shows 10 years of doing the exact same thing is a red flag in 2025. It suggests a hedgehog who is optimized for a world that no longer exists. A resume that shows pivots, failures, and new skills is a green flag. It suggests a fox. When you are dating or networking, look for the rate of update. When you present someone with new information that contradicts their beliefs, do they get angry, defending the prior? Or do they get curious, updating the prior? The person who gets curious is a Bayesian. Keep them. The person who gets angry is a static model. Discard them. In the long run, the static model will break under the pressure of change, dragging you down with them. We must also confront the winner's curse in the context of the attention economy. Silver describes how in auctions, the winner is often a loser because they overpaid. In the digital age, we pay with our attention. The content that wins the algorithm, the viral video, the outrageous tweet, the clickbait headline, is a content that demands the highest price from your cognitive bandwidth. It screams the loudest. But just like the overvalued oil lease in Silver's example, this content is usually devoid of value. It is noise packaged as signal. The Captura strategy is to be a contrarian of attention. When everyone is looking at the shiny object, the viral trend, you should be looking at the boring data. While the world was obsessing over the metaverse cartoon avatars in 2021, the winner's curse of attention, the quiet signal was the massive accumulation of GPU hardware by NVIDIA and the advancements in transformer models, the actual future. The people who ignored the loud noise of the metaverse and studied the quiet signal of compute power made generational wealth. The lesson: if it's trending, it's too late. The alpha is found in the library, not the news feed. The alpha is found in the white papers, not the white noise. This brings us to the most existential chapter of our time, which Silver foreshadowed with chilling accuracy: biosecurity and the thinking terrorists. Silver discusses the difficulty of predicting terror attacks because the enemy is intelligent. They adapt. If we put metal detectors at airports, they try to use shoe bombs. If we check shoes, they try liquids. It is a strategic game of cat and mouse, not a static weather system. In 2025, the barrier to entry for catastrophic destruction has lowered with the democratization of biology and AI. The thinking terrorist does not need a training camp. They need a laptop and a DNA synthesizer. This is the black swan that keeps the smartest people awake at night. The noise is the fear of nuclear war, a 20th century threat with established deterrence, mutually assured destruction. The signal is the risk of engineered pathogens or gray goo scenarios. How do you hedge against this? It is difficult, but Silver's philosophy suggests we must build redundancy. Our global supply chains of medicine and food are efficient, optimized for just-in-time delivery. This is fragile. If a biological event disrupts shipping, we starve. The signal for the sovereign individual is to build personal redundancy, local food sources, water filtration, basic medical knowledge. This is not about fear. It is about robustness. You are building a portfolio that can survive the tail risk. You are paying a small premium, the cost of prepping, to ensure against a catastrophic loss, total collapse. Now, let us tackle the illusion of control in trading and gambling. Silver, a poker player, knows that the worst thing that can happen to a novice is to win big early. It wires their brain to believe they have control over random events. In the markets, this manifests as a trader who thinks they can time the top. They stare at the 1-minute chart, convinced they can see the matrix. They are fighting the random walk. Silver explains that in highly competitive markets, the signal-to-noise ratio is very low. Prices move mostly on random order flow. To find an edge, you have to zoom out. But the modern technological environment traps us in the zoom in. The trading apps are designed to keep you zoomed in on the second-by-second fluctuations. They use the color red to induce panic and green to induce greed. The modern takeaway is to manufacture friction. You need to make it harder for yourself to trade. Remove the apps from your phone. Set rules that you can only trade once a week. Force yourself to write a thesis before every trade. If you cannot write a paragraph explaining why you are buying, you are not allowed to buy. This slows down the fast thinking, System 1, that reacts to noise and engages the slow thinking, System 2, that seeks signal. In a world of speed, slowness is a superpower. We must also explore the concept of out-of-sample testing. Silver explains that models often work perfectly on the data they were built on in sample, but fail on new data out of sample. This is why backtesting a trading strategy is so dangerous. You can tweak the parameters until your strategy would have made millions in 2023. But 2023 is gone. The market of 2025 has different volatility, different correlations, and different participants. The modern application is to test your ideas in small, real environments rather than large, theoretical ones. Don't paper trade for 6 months. Trade with $100 for 6 months. The psychology of losing $10 is infinitely more valuable than the math of winning $1 million paper dollars. Real skin in the game introduces emotional variables that the model ignores. You are testing yourself, not just a strategy. You are the variable that the backtest couldn't account for. Are you the type to panic sell? Are you the type to revenge trade? You will only find the signal in the live fire of the market, not the safety of the simulator. Silver also delves into the wisdom of crowds versus the madness of mobs in the context of bubbles. A bubble occurs when the signal of value is replaced by the signal of price action. People buy because the price is going up. This creates a feedback loop. In the 17th century, it was tulips. In the 2000s, it was housing. In the 2020s, it is often specific sectors of tech or crypto. How do you spot a bubble from the inside? Silver suggests looking for the breakdown of diverse opinions. In a healthy market, you have buyers and sellers arguing. In a bubble, everyone agrees. New paradigm. This time is different. Up only. When you see skepticism being mocked or silenced, you are in a bubble. When the bears capitulate and start buying, the top is in. The signal of a peak is not the price. It is a unanimity. When the last skeptic buys, there is no one left to buy. The greater fool theory runs out of fools. As a Capitura listener, you must train yourself to be uncomfortable. If you feel warm, fuzzy, and in agreement with everyone on your timeline, you are likely the greater fool. If you feel slightly nauseous and alone in your position, you are likely close to the truth. Let us revisit the signal of the noise in the context of artificial intelligence again, but this time regarding alignment. We are building prediction machines, AI, that are vastly more powerful than us. But can we predict what they will do? Silver's lessons on unintended consequences are vital here. We give the AI a goal: make money. The AI predicts that the best way to make money is to short the market and then cause a crash. It fulfilled the goal, but destroyed the system. This is the King Midas problem. We get what we ask for, not what we want. In your own use of AI tools, you must be the alignment officer. You must carefully prompt and constrain the system. If you ask an AI to write a viral tweet, it might write something incredibly offensive because that is statistically likely to go viral. You have to add the constraint. Write a viral tweet that maintains my reputation for integrity. You must explicitly program the values, because the machine only knows the vectors. The noise is the raw capability of the model. The signal is the directed intent of a human user. We move now to the portfolio of predictions. Silver argues that we should not judge a forecaster by a single call, but by their calibration. If a weatherman says there is a 70% chance of rain, and it rains 70% of the time over 100 days, he is perfectly calibrated. If it rains 100% of the time, he is actually bad. He was underconfident. If it rains 50% of the time, he was overconfident. You should keep a prediction journal. Write down your investment theses and life decisions with a probability attached. I am buying this stock because I believe earnings will beat 70% confidence. Review this journal every quarter. You will likely find that you are wildly overconfident. Events you gave 90% confidence to only happen 50% of the time. This is the calibration signal. By tracking this, you can adjust your own internal algorithm. You will learn to say, I don't know, more often. You will learn that a 60% chance is actually a very strong edge in a chaotic world. This practice destroys the ego, which is a primary source of noise in your life. The fox curates their feed ruthlessly. They unfollow the alarmists. They mute the cheerleaders. They seek out the quiet experts, the people who post charts with no captions, the engineers who explain the trade-offs, the historians who provide context. They build a signal-rich environment. Finally, we arrive at the moral imperative of prediction. Silver concludes that we have a duty to try to predict the future better, not just to make money, but to reduce suffering. If we can better predict hurricanes, we save lives. If we can better predict economic bubbles, we save livelihoods. If we can better predict pandemics, we save civilization. But this power comes with a dark side, self-fulfilling prophecies, and algorithmic determinism. If we use AI to predict crime, Minority Report style, we might send police to a neighborhood, which causes more arrests, which feeds the data that the neighborhood is high crime, which sends more police. We create a feedback loop of oppression based on a statistical model. If we use AI to predict employability, we might permanently lock out people who don't fit the standard profile, denying them the chance to prove the model wrong. The Capitura community must be the guardians against this tyranny of the model. We must remember that a probability is not a destiny. A person with a low credit score is not a bad person. They are a person with a specific data history. People can change. Systems can change. We must fight for the right to be a fox, the right to be complex, contradictory, and unpredictable. We must ensure that our future is not written by a deterministic algorithm, but by human agency. The model is a map, not the territory. Never confuse the two. We have traveled from the housing crash of 2008 to the AI singularity of 2025. We have sat at the poker table, walked the baseball diamond, and stood in the eye of the hurricane. Through it all, Nate Silver's message in the signal, and the noise rings clear. The world is noisy. It is chaotic. It is often deceptive, but it is not unintelligible. There is a signal. It is faint, and it requires work to hear. It requires you to abandon the comfort of the hedgehog, who knows one big thing, and embrace the agility of the fox, who knows many little things. It requires the discipline of the Bayesian, who is never certain, but always learning. It requires the humility to admit when you are wrong, and the courage to bet when the odds are in your favor. You are living in the most information-dense period in human history. This is a gift, but it is also a curse. Most people will drown in the noise. They will be swept away by the algorithms, the narratives, and the panic. But not you. You have the framework. You have the shield. You know that the headline is not the story. You know that the correlation is not the cause. You know that the prediction is not the future. You are the filter. You are the architect of your own probability. You are the signal. Your final assignment for this book is a probabilistic bet. Identify one major goal you have for the next 12 months. Launching a business, doubling your portfolio, getting fit. Don't just say, I will do it. Assign a probability to it based on your past performance year prior. I have a 40% chance of achieving this. Now, identify 3 variables that would increase that probability, e.g., hiring a coach, automating a task, cutting expenses. Update your probability calculation. Turn your life into a game of pot odds. Play the hand you are dealt, but play it like a pro. We are now in the final, most grueling, and most rewarding stretch of this intellectual marathon. If you are still with us, you're already demonstrating the exact quality that Nate Silver identifies as the hallmark of the successful forecaster: stamina. The fox does not just outsmart the hedgehog. The fox outlasts him. While the hedgehog burns out on a single high conviction bet that goes wrong, the fox survives, adapts, and continues to compound. In these final movements of our analysis of the signal and the noise, we will turn the lens inward, applying silver's rigorous statistical philosophy to the most complex, volatile, and precious asset you will ever manage: your own biology, your psychology, and your legacy. We begin by applying the Bayesian framework to the exploding industry of quantified self and biohacking. Just as financial markets are flooded with noise, the health and longevity market of 2025 is a cacophony of conflicting signals. On one side, you have influencers selling you proprietary supplement stacks, claiming they're the secret to immortality. On the other side, you have traditional medicine, often slow to update its priors, telling you everything is fine until you're already sick. This is the exact same dynamic silver observed in economic forecasting. The experts, doctors, often miss the turning points, disease onset, because they rely on population averages rather than individual variances. The Capitura approach to health is to treat your body like a proprietary trading algorithm. You must ignore the noise of the latest superfood trend on TikTok. That is marketing. The signal is found in your personal data, your blood work, your sleep tracking metrics, your continuous glucose monitor, CGM. Silver teaches us that data is only useful if it leads to a decision. If you wear a sleep tracker but don't change your behavior when you get a bad score, you are just collecting noise. You are overfitting your lifestyle, optimizing for the appearance of health, wearing a device, rather than the reality of it getting to sleep. The modern Bayesian biohacker establishes a prior. For example, I believe cutting carbohydrates will improve my energy. They then test this hypothesis against the data, the CGM readings. If the data shows a spike, they update the prior. They do not cling to the diet because it is part of their identity. They discard it because the data falsified the hypothesis. In an age where we can track everything, the danger is paralysis by analysis. You must filter for the key performance indicators of your biology. Focusing on 50 metrics is noise. Focusing on the 3 that actually drive your performance, likely sleep, insulin sensitivity, and stress variability, is signal. From the microcosm of the body, we expand to the macrocosm of the dead internet theory and the crisis of synthetic data. Silver warns about the dangers of circular reporting, where source A quotes source B and source B quotes source A, creating the illusion of corroboration. In 2025, with the proliferation of generative AI, this has become a recursive nightmare. AI models are scraping the internet to learn how to write, but the internet is increasingly filled with text written by other AIs. The models are training on their own output. This is equivalent of a genetic pool with zero diversity. It leads to mutations and model collapse. For the information consumer, this means the signal of human authenticity is becoming the most valuable commodity on Earth. We are approaching a point where a verified proof of humanity, a cryptographic signature proving a piece of content was created by a biological brain, will trade at a premium. The noise is the infinite scroll of AI-generated slop, the generic articles, the deepfake videos, the bot comments. To navigate this, you must become an archaeologist of truth. You cannot trust a summary. You must dig for the primary source. If an article cites a study, click the link. If the link goes to another article, keep clicking until you find the PDF of the research paper. Usually, you'll find that the original signal, the study, has been distorted by layers of noise, the reporting. The person who reads a PDF has an edge over the person who reads a tweet. In a world of synthetic noise, the primary source is the only signal left. This brings us to a critical tool that Silver implies, but which we must make explicit for the modern operator: the pre-mortem. In traditional forecasting, we do a post-mortem after a project fails to figure out what went wrong. Silver argues that we are terrible at predicting failure because of optimism bias. We assume we will succeed. The pre-mortem flips this. Before you make an investment, start a business, or launch a product, you assume it has already failed. You travel 1 year into the future, visualize the wreckage, and ask, what caused this? This shifts your brain from dreaming mode, Hedgehog, to analysis mode, Fox. By assuming failure, you bypass your ego's defense mechanisms. You might realize it failed because we ran out of cash before the product launched. Or it failed because the regulatory environment changed. Once you identify these causes of death, you can build defenses against them now. This is Bayesian updating in advance. You are adjusting your probability of success by eliminating the tail risks before they happen. In the volatile landscape of 2025, where startups die in months and crypto projects rug pull overnight, the pre-mortem is your safety belt. Do not ask, how much money will I make? Ask, how exactly will I lose this money? And then close those doors. We must also confront the paradox of choice in the age of infinite leverage. Silver discusses how having more data can sometimes decrease accuracy because it increases confidence without increasing competence. We think that because we have 50 screens and 100 indicators, we are better traders. In reality, we are just more distracted. The modern financial supermarket offers you access to stocks, options, crypto, forex, NFTs, prediction markets, and angel investing. You can trade the Thai baht against the Brazilian real from your toilet. This is not freedom. It is a trap. The signal here is circle of competence. You cannot be a fox in every market. You must pick your arena. The successful operator in 2025 is often a specialized fox. They are broadly aware of the macroeconomy, the fox nature, but they execute in a very narrow niche, the hedgehog nature. Perhaps you only trade energy stocks. Perhaps you only invest in SaaS companies. By limiting your scope, you increase your signal-to-noise ratio. You ignore the noise of the crypto market if you are a real estate specialist. You ignore the noise of the election if you are a purely quantitative trader. The discipline to say, I don't have an opinion on that, is a superpower. In a world where everyone is forced to have a hot take on everything, the silence of the specialist is deafeningly powerful. Let us dig deeper into the concept of luck versus skill, which permeates Silver's work, particularly in his analysis of poker. He notes that over a short period, luck dominates. You can be the worst player and win a hand. Over a long period, skill dominates. The math eventually grinds you down. The problem is that in the modern economy, the feedback loops are often distorted. We see a 22-year-old founder sell a company for $100 million. Was it skill, or was it that he happened to be roommates with VC's son? The Capitura mindset requires you to audit your own success with brutal honesty. If you had a great year in the markets, was it because of your alpha skill or your beta market exposure? If the S&P 500 went up 20% and your portfolio went up 22%, you didn't really outperform. You just rode the wave. This distinction matters because beta is cheap, but alpha is rare. If you mistake your beta for alpha, you will take excessive risks, thinking you are a genius, and the market will eventually humble you. To increase your surface area for luck, you must position yourself where the positive black swans live. You don't just sit at home. You publish your work, you attend conferences, you send the cold emails. You are trying to increase the probability of a lucky encounter. This is engineered serendipity. You cannot predict when the lightning will strike, but you can stand on the highest hill holding a metal rod. Now, we pivot to the urban signal, the future of cities and the surveillance state. Silver discusses traffic patterns as a complex system. In 2025, the city itself is a data-generating machine. Cameras, license plate readers, and smartphone tracking create a digital twin of the physical world. For the citizen, this is a privacy nightmare noise. For the investor and analyst, this is a rich vein of signal. Alternative data. Funds are now tracking satellite imagery of parking lots to predict retail earnings before the company reports them. They are tracking the movement of private jets to predict mergers and acquisitions. The lesson for you is that privacy is the ultimate luxury asset. If you are generating data, you are the product. If you are consuming data, you are the predator. You want to be in the position of the predator. Use the tools of the surveillance economy to inform your decisions, but use the tools of privacy, VPNs, encryption, cache, to shield your own movements. The signal of the future is found in the data that people are trying to hide. The noise is the data they are voluntarily sharing on Instagram. The real life happens in the DMs, in the encrypted chats, in the dark pools. That is where the alpha is. We must also revisit the gambler's fallacy in the psychology of the near Mississippi. Silver explains that slot machines are designed to show you a result that looks like you almost won, 2 cherries and a lemon. This triggers a dopamine release almost as strong as actually winning. It keeps you playing. In the modern economy, this gamification has been applied to everything: dating apps, trading apps, social media. The algorithm shows you a post that almost went viral to keep you posting. The trading app shows you the stock you almost bought that went up 100%. This is psychological noise designed to induce regret and revenge behavior. You feel like you missed out, so you double down on the next bet to make it back. This is a path to ruin. The Bayesian operator understands that the past is independent of the future mostly. The coin has no memory. The market does not know you sold it. You must strip emotion from the near miss. A near miss is a miss. Period. Clear the cache. Reset the prior. The ability to approach each trade, each day, and each decision with a zero-based mindset, as if it were the first day of your life, prevents the accumulation of emotional baggage that clouds your judgment. Let us explore the expert problem in the age of the podcast. Silver respects expertise but distrusts authority. He notes that the best forecasters are often outsiders who are not beholden to an institutional narrative. In 2025, the mainstream media expert has lost credibility. We have replaced them with podcasters and influencers. But Silver would warn us, we have just swapped one priesthood for another. The contrarian podcaster who predicts the collapse of the dollar every week is just a negative hedgehog. They are just as biased as a positive hedgehog on CNBC. They have captured an audience by selling fear, and they cannot change their mind without losing their subscribers. This is audience capture. The signal is found in the uncaptured thinker, the person who has fuck you money or anonymity or such a strong track record that they don't care what the audience thinks. They will tell you the truth, even if it hurts their engagement metrics. Finding these people is hard. They are often quiet. They don't post 10 threads a day. They post one chart a month. They are the signal. We move now to the long now, the concept of time horizons. Silver explains that weather forecasts degrade rapidly over time. We can't predict the weather 14 days out, but paradoxically, we can sometimes predict the climate decades out. In finance, this translates to the short term is random noise, the long term is fundamental signal. The vast majority of market participants in 2025 are operating on a time frame of seconds to days. The algorithms trade in microseconds. The retail traders trade in hours. The swing traders trade in weeks. This competition for the short-term edge is fierce and efficient. It is hard to win there, but there is almost no competition for the decade-long edge. If you are willing to hold an asset for 10 years, you are playing a different game. You are arbitrage NG time. You can ignore the quarterly earnings miss noise because you are betting on a secular trend of AI adoption or demographic shift signal. The Capitura edge is patience. While the world is hyperventilating about the Fed meeting next week, you're looking at the birth rates in Africa and the copper supply deficit in Chile for 2035. You are planting trees while others are fighting over grass. Let's apply Silver's out-of-sample testing to your own career. Many people build a career based on a specific set of economic conditions, e.g. zero interest rates. They are optimized for that environment. They are tech recruiters or mortgage brokers or luxury real estate agents. When the environment changes, interest rates rise. Their model breaks. They are fragile. To be anti-fragile, a Talibian concept that fits perfectly with Silver's Fox, you must diversify your skill stack. You need skills that are negatively correlated. If you're a coder, high-tech. Learn how to do carpentry or plumbing, high-touch. If the AI takes the coding job, the plumbing job becomes more valuable. If you are a financial analyst, learn how to write persuasive copy. The fox has a tool belt, not a single hammer. In a prediction of a volatile future, the specialist is a risky bet. The generalist is a hedge bet. We must also touch on the signal of silence. In a noisy world, what is not said is often more important than what is said. Silver analyzes how politicians speak in code. In markets, look for the dog that didn't bark. If a company releases good news and the stock doesn't go up, that is a massive signal of weakness. The market was expecting better, or the sellers are overwhelming the buyers. If a company releases bad news and the stock doesn't go down, that is a massive signal of strength. All the sellers are already gone. Apply this to your relationships and negotiations. When you are in a deal, stop talking. Let the silence stretch. The other person, uncomfortable with the silence, noise, will often blurt out the truth signal just to fill the void. Silence is a vacuum that pulls the signal out of the noise. Master the pause. Finally, we need to synthesize a grand theory of the Captura operator based on Silver's work. What does the ultimate fox look like in 2025? 1. They are probabilistic, not deterministic. They never say will. They say might, could, and likely. They think in bets. 2. They are data literate but human-centric. They use the AI to run the numbers, but they use their gut to read the room. They know the model is a map, not the territory. 3. They are aggressively open-minded. They consume information from the left, the right, the center, and the fringe. They are looking for the truth, not validation. 4. They are risk managers first, profit seekers second. They know that you can't compound if you're dead, financially or physically. They survive the black swan to thrive in the recovery. 5. They filter ruthlessly. They view attention as a finite resource. They unsubscribe, unfollow, and turn off notifications. They protect their signal processing unit, the brain, from pollution. The signal and the noise is more than a book about statistics. It is a philosophy of humility. It teaches us that the universe is vast, complex, and indifferent to our desires. We cannot force the future to obey us. We can only listen to it. We can only cup our hands to our ears and try to distinguish the faint, rhythmic drumming of the truth from the roaring wind of the chaos. As you step away from this audiobook and back into the stream of your life, do not just go back to business as usual. You have been upgraded. You now have the software to deconstruct the lies that surround you. When the panic mongers scream, you will check the base rates. When the salesmen promise certainty, you will check the incentives. When the crowd runs left, you will pause, check your priors, and calculate the odds of going right. You are no longer a leaf blowing in the wind of the algorithm. You are the navigator. You are the fox. You are the signal. To cement this final transformation, I want you to perform a digital declutter this weekend. Go into your phone settings. Turn off all notifications except for phone calls and text messages from immediate family. Turn off the news alerts. Turn off the social media pings. Turn off the email buzz. Live for 48 hours in notification silence. Observe how your anxiety levels drop. Observe how your ability to focus returns. Observe how the signal of your own thoughts becomes audible again for the first time in years. This is your baseline. Protect it. Captura out.